Here's our part 3 of our chapter 10 video lecture, where we're going to focus on an amount called the adjusted basis. If you remember, again, that's inside of our gain or loss formula, where we start off with the sales price for the property we just sold, minusing out any related selling expenses, like the big one was sales commissions, to get the difference of an amount realized. And then we subtract out this adjusted basis we're learning here to either get a gain if the amount realized is larger than the adjusted basis, or a loss where the adjusted basis is larger than the amount realized. And you can see here that the adjusted basis is equal to the basis we start off with when we first acquire the property, plus any additional costs we incur to make improvements to the property, here called capital additions. Then we subtract out something called capital recoveries. Let me briefly discuss capital recoveries first. The main one that we subtract out here is called depreciation, or accumulated depreciation that relates to business use property. And we won't get into business use until next semester in the next tax class called Accounting 137. I believe students currently in our 134 class can probably start registering for next semester's class in a couple of weeks. Yeah. So go ahead and sign up for that 137 class. And we'll learn about this accumulated depreciation for business use. Another recovery would be maybe if the owner of the property has received insurance proceeds if some part of the property has been destroyed or damaged. Another recovery would be from the government or maybe even a utility to make use of their property. Sometimes we call that a condemnation or an easement. Yeah, so maybe the utility wants to run an electrical line through your property, and they compensate you for that by giving you some type of proceeds that you subtract now from your initial basis. Let's talk about any additional amounts you're going to add to that basis. So our textbook goes through some examples here. So for example, you install a new furnace. Well, here in Hawaii, probably this would be an AC unit, yeah? Or you re-roof your building. What you're really supposed to do is also subtract out the cost of the old AC or the old roof before you add in the new one. Here you're putting in a new fence for your real property or repaving the driveway. In the case of a car engine here, technically you're supposed to subtract out the cost of the old engine before you add in the cost of the new one. You're landscaping your property, so the cost can be added to the total cost of the property. Here you're adding a room to your home, yeah, or a room to your building. You're expanding the property. You're making the life longer to the property with these costs. Now, if the cost is just routine repair and maintenance, that's not added to the cost of the property. If it's for business use, repair and maintenance can be deducted right away. If it's for personal use property, it's a cost incurred, but you cannot deduct it. And again, you cannot add it to the property costs if it's, again, simple repair and maintenance. Let's take a look at the next amount here called initial basis, what you start off with. And the most common type of initial basis is where you buy the property. So this is the amount you have to pay for it. Maybe you have to borrow money. That would be part of the purchase price. But inside of this initial basis would be any sales taxes you have to pay. Title insurance and survey costs, typically this will be paid by the seller, not the buyer. But if the buyer has to pay for it, then that would be added to the purchase price. Here is shipping costs, installation costs, costs incurred just to test the property before it gets ready for use. This is especially true for business use, yeah? And here's all the paperwork costs for acquiring the property. All of this cost is combined together for the initial purchase price, yeah, the initial basis. So another way, well, let's talk about bargain purchases. If you remember back in chapter 3, where we had fringe benefits for employees, one fringe benefit would maybe be employers allowing employees to buy property at a discounted price. And that discount generally is tax free if it doesn't go below the cost to the employer. But if it goes below the cost, that difference is going to be taxable to the employees. And then the basis now to the employee would be what they pay plus whatever income they had to report as taxable. Okay, so that's a bargain purchase. Here's a common situation for real estate. When you buy real estate, you're really buying a bunch of stuff or a basket of items here. So you're paying just one price, this purchase price, but you gotta divide up that purchase price between the different items you bought. And of course, the main items you buy in for real estate purchase would be the land and whatever is sitting on the land, the building or improvements. So here's an example, this example 11. The total purchase price is 90,000. That's for both the land and building together. But then we got to allocate that 90,000 between the two. So we determine the so-called fair market value of each item. We're told the land is worth 80 and the building is worth 40. So total 120, which is kind of unusual, right? You would think you would pay 120 if the value is 120. But again, we're just using with these figures. So in this denominator here, we use 120,000. And in the numerator, for each item, one at a time, here would be the land. The land and building cost would be a total of 90. So we multiply all of this out to get the cost allocated to the land of 60. Then we change this value to the value of the building, which is 40, and multiply it all out again to get a cost allocated to the building of 30. Or you can just take the total cost minus the land to get the building costs here also. Okay, so important to use real costs, this purchase price here, and allocate it to the specific items as a, here they call it again, a basket. And if this building had equipment inside, you also have to allocate costs to the equipment. Here it mentions transferring property between spouses. We'll talk about gifts between individuals in a few minutes, but here, typically we're talking about divorce settlements. Property settlements when you're splitting up the property among a divorced couple. And the general rule we learned back in chapter 3 is there's no gain or loss realized or recognized. But what's important is now the cost basis will be kept by both spouses or be transferred between the spouses. So let's say you have $1 million of assets, yeah, and they're gonna, or 2 million, so you're gonna split it up 50-50, $1 million each. Not only is the value important, but also the cost basis of the property is important. What you want is, of course, to get the $1 million share, but you also want to have a higher cost basis. So eventually, if the property is sold, you get to deduct a higher basis and resulting in a lower gain. Okay, so what's important again is not just value, but basis. Yeah, and in the case of a couple splitting up, being divorced, the basis will be kept the same among the spouses, between the spouses. So let's talk about now property not being bought, but here being inherited from a person called a decedent. The person receiving the property is called an heir, or sometimes called a beneficiary. And this is a typical planning technique. If the decedent has lots of property that was purchased at a cost basis at a low price, But now, um, when they are near passing away, if they sell it, there's going to be a big gain because of the appreciation in value. Instead of having the decedent sell it, what you can do is have the decedent pass away owning the property. And now when the heir, the beneficiary receives the property, they're going to have a cost basis that's what we call stepped up to the fair market value at the date of the decedent's death. So now if the beneficiary sells that property, let's say right away, they're probably going to have this fair market value being received, minusing out the fair market value at the day of death, equal to a zero gain. They pay no income taxes. An option to this value at the date of death is to do something called an alternate valuation date. If the property is sitting in something called an estate that is managed by an executor or a personal representative who could be the same person as the beneficiary. What they possibly could do is wait a while and then distribute out the property and use that value at the distribution date instead of the date of death if the value is larger. You want to use again the larger amount, and that can be all the way up to 6 months after the date of death. This is what we call an election. It's up to this executor person, the personal representative, to make this choice here of what date to use for the valuation. Let's talk about a little bit more complex situation is when the person giving the property gives it away before they pass away. And we call that a gift. There's two broad situations. The simpler of the two is if the gift has a fair market value that is not less but greater than the basis of the person that gave away the property, here called the donor. The person receiving the property is called a donee. And again, when the gift is made, if the value of the gift is larger than the basis of the donor, that the donee is going to receive the property with a basis equal to the basis of the donor. They just step right into the shoes of the donor, even using the same date that the donee had acquired the property. Now, the harder situation is if the value has gone down as the donor owned the property. So now, when the property is distributed from the donor to the donee and the value is less, the basis to the donee is going to be either the fair market value at the date of the gift or the cost basis of the donor. It depends. It depends upon when the donee sells the property or distributes out, gets rid of the property. Okay, so let's see if we can illustrate this out again. So we have the donor that already has some type of adjusted basis to the property that they're going to give up. And they're going to transfer this as a gift to the donee. And if at the time of the gift, the fair market value, let's see, is greater than the adjusted basis. So here the adjusted basis is less than the fair market value. This adjusted basis will now be used by the donee. So let's say now the adjusted basis is greater than the fair market value at the date of the gift. What the donee is going to use as a basis will depend upon eventually if the donee, when the donee sells or disposes of the property. And that amount can either be larger than or smaller than these two amounts over here. Okay, so let's say that the value keeps on going down as now the donee receives the property and eventually disposes of the property. So here is the sales price when the donee sells the property, and it's less than this this adjusted basis. Okay, let's do that again. Yeah, this adjusted basis here. What you're going to do is use this adjusted basis to figure out the loss. Now, if the sales price to the donee is larger than the fair market value at the date of the gift, you're going to use this fair market value at the date of the gift and figure out the gain to report. By using this smaller amount or this larger amount, what you're doing is you're minimizing the loss. You're minimizing the gain. So tell me, what would happen if you sell your asset, the donee, between this adjusted sales price and this fair market value? Okay, so the sales price falls in between the two. The donee is going to use the sales price as the cost basis. So tell me, what's the gain or loss? So you can see how complex this is. It all boils down to this original gift, and the cost basis was less than the fair market value. And then you're going to have these three possible situations. If at the time of the gift, the value was larger than the adjusted basis. Again, we just use the adjusted basis no matter what, eventually when the donee disposes of the property. So I kind of summarized the rule here, but you got to take a look at the examples in the book here to see all these three possible situations. Now, something comparable to that value or the cost basis being used is when property is converted from personal use to business use. The typical example is you use your home for personal use and then later on you start to rent it out, or you use your car for personal use and now you convert it to a company car. Let's go back to that scratch paper again. So kind of like this situation here. So let's say that again you have a personal use asset that you already have some type of adjusted basis, and you're going to convert that to a profit motive, a business use. Again, the typical situation would be your home and you convert it to a rental property, rental. Or maybe your car and then you convert it to a delivery automobile. So again, you have your basis here, and at the time you convert it, you got to look at the fair market value. If the adjusted basis is, how did it go now? The fair market value is greater than the adjusted basis. You're going to use your adjusted basis now as the basis for business use. If your basis is less than the fair market value at the time you convert it to business, and that's kind of true probably for automobiles, maybe not true for rental. What you're going to do, again, if this is true, basis bigger than fair market value, you're going to use the fair market value here as your initial cost basis for business use. It comes into play when you calculate out depreciation. And again, that's a topic for next semester. But take a look at the example in our book to see how either this basis or this basis here will be used eventually when the property is sold after business use is completed. Okay, that's this topic here. Let's look at the next topic. which is talking about owning shares of stock in a corporation. And we have to identify which shares we're going to sell that may have different costs. Again, let's look at a scratch paper here. So let's say that we have the number of shares here is 100 shares we bought, and each share we had paid a price of $10. So that's going to give us a total cost of $1,000. So if you sell one share of stock, you're going to use a cost of $10. If you sell two shares of stock, you're going to use a cost of $20 and so forth. Yeah, pretty simple because every one of these shares here has the same per unit cost. But let's say that you have 100 shares, of which 50 was bought at 10, and then later on you bought more, another 50, let's say at 20. So total cost of 500, total cost of 1,000, grand total of 1,500. And let's say you sell two shares. What's the cost you're going to use? Again, you still have 100, and the average cost would be $15 each, but you're not going to use average. Okay, you don't use average costs for selling shares of stock of one company. What you gotta do is identify where is the two shares coming from. Is it from these 50 here at $10 each, or these 50 here at $20 each? For tax purposes, assuming both are what we call either long-term or both we call short-term, and we'll learn about that in the next chapter. What you want to do is use the one that has a bigger cost. You get to deduct more costs, reducing the profit you have to report. So when you sell the stock, you got to tell your broker, oh, it's coming from this lot here, the two shares I'm selling, and not this one. So now eventually you'll still have 50 of this, but only 48 of the more expensive, costly stock. Now, if you don't identify which lot the two shares came from, the automatic rule is to take it from the older lot, the cheaper lot, in this case, the $10 each. Yeah, so it may be best for you to identify which lot it came from. But now again, if you go back to this example, if everything's at the same price, it really doesn't matter. Yeah, it only matters if you have costs that are different. Let's talk about, let's see, a couple different topics here under stocks. One is called stock split, and something similar called a stock dividend. The Apple Corporation, those iPhone, iWatch companies, just went through, I believe, a stock split. So let's say that you have, again, that 100 shares that you bought each at $10, total cost of 1,000. A stock split is when the company will give you more shares of stock just to make the stock more marketable. More shares can be bought and sold more easily. So let's say the stock split is what we call 2-for-1. For every one share you have, now you're going to have two shares. So you may have to redeem your 100 shares, but they're going to give you back 200 shares. Now, this is tax-free. Stock splits and most stock dividends are tax-free. So your cost is still the same, still the original 1,000. But now each share you have to calculate the cost. So it should come out to $5 a share. In other words, 200 shares times $5 a share equals the same $1,000. So if you sell two shares of this 200 here, you don't get to deduct $20 like in the previous example. You get to deduct 2 times 10 or $10, yeah? Okay, you have more shares, but the cost per share went down proportionately. Let me illustrate a stock dividend. Well, stock dividends, if they're tax-free, all you're doing is just increasing the total number of shares you have. the company will give you, let's say, 10 shares, a stock dividend, and if it's tax-free, you just add on the number of shares here. And the total cost is still the same, your original cost. And you need to, again, calculate out the per share cost. So 1,000 divided by 210. I don't have my calculator, so that comes out to the amount per share here. And this is what you get to deduct for each share you sell. Let's talk about reinvested dividends. So here's our corporation, and here is our shareholder, taxpayer, stockholder. And we learned back in chapter 3, the corporation will pay dividends to our shareholder, reported on Form 1099 DIV, taxable dividends. Again, not stock dividends. Yeah, this is a cash dividend. But some corporations have a program where you can use that dividend, let's say pay it back, to reinvest and buy more shares of stock, probably at a slightly discounted price, yeah, to motivate people to reinvest in the corporation. Again, they call that a program a dividend reinvestment program, or DRIP. This dividend is still taxable even though you reinvest the proceeds back to the corporation. Now, the cost of this stock you're reinvesting is the same amount as income you're reporting on your tax return. That probably is going to be different than the underlying cost of the shares you already own. So again, you got to keep track of that. And good brokers or good corporations will keep track of that cost for you. Otherwise, you got to keep track of this minute detail yourself. A possibly more common situation, instead of investing in a corporation, to diversify, many people will invest in what we call exchange traded funds or mutual funds, or this entity invests in many corporations. Yeah, dozens of different corporations to diversify, and these corporations will pay dividends to the fund, and in turn, the fund will pay dividends to the shareholder, and most shareholders will reinvest into that fund. Again, reporting taxable income. Also, the cost here of the stock is going to be equal to that income, and it's going to vary every time you reinvest compared to the initial stock investment. So again, I'm pretty sure most funds will keep track of the cost for you. And you got to identify eventually, if you redeem or sell your shares, which cost you're going to use. Otherwise, our textbook mentions the cost is determined under the FIFO method. Yeah, first in is going to be sold first. I think that's it for this part 3 video. Okay, when we come back in part 4, we'll talk about certain situations where gains are possibly unrecognized or deferred later on until something else happens. Okay, take a look at that last part 4 video.